And if you want to learn more about how systems and probability shape our lives, check out the resources in the description. Thanks for watching. Alright, so you want to understand how private ATM networks actually make money? Or at the very least, you want to know what actually happens after an ATM owner deploys their machine and starts collecting transaction fees. First of all, a legitimate private ATM network requires anywhere from $5 million to $50 million in initial capital just to launch legally across multiple states. That's more than the annual budget of some small municipalities. But here's the strange part. The company operating the ATM network usually doesn't own the machines. And more importantly, how does owning a $50 million ATM infrastructure actually make you money? Because in private ATM networks, ownership is a completely different business than operation, and it's far riskier than it looks. When people hear private ATM, they imagine a simple machine in a convenience store where you withdraw cash and pay a fee. But a modern private ATM network is essentially a distributed, self-sustaining financial machine. It consists of thousands of individual machines, sophisticated encryption and security systems, payment processing networks, real-time transaction monitoring, and regulatory compliance frameworks, all integrated into a structure designed to extract maximum value from transactions while operating in legal gray zones across multiple jurisdictions. It has processing servers capable of handling millions of transactions per day, all built for an expected operational life of 7 to 12 years before becoming obsolete or facing regulatory collapse. Take a large ATM network ordered from a major manufacturer like NCR or Diebold, but the prices are not random. It all depends on the geographic markets you choose, the type of machines you want in your network, the payment processing infrastructure you select, the cash logistics you arrange, and the production capacity of the manufacturer you're ordering from. And then there's global cash demand, the ultimate wild card that shapes everything. ATM network valuations don't behave like real estate. They behave like volatile stocks on steroids. When cash usage is expanding and regulations are loose, ATM network valuations surge dramatically. During regulatory crackdowns and the push toward cashless society, they collapse with staggering speed. For example, when several states implemented strict ATM surcharge regulations limiting fees to $2, some ATM companies lost 60% of their value in a single year. Networks that cost $50 million to build were suddenly worth $20 million before they even generated significant revenue, simply because demand had evaporated overnight in major markets. In global ATM networks, there are three main players: the machine manufacturers, the network operators, and the network owners, and almost always they're completely separate companies with diverging interests. For example, a global ATM operator like Cardtronics or MoneyPass operates thousands of different ATM machines and networks. You see their logos on machines and advertisements, but they do not own all of those ATMs. In fact, many operators prefer to own as few as possible because ownership is a capital-intensive nightmare. Many are simply licensed from distant owners you'll never meet. So who holds the deed to that $50 million piece of financial infrastructure? It might be an ATM holding company like Cardtronics Holdings, which owns thousands of machines across their portfolio. It could be a wealthy individual from Eastern Europe or Asia who views ATM ownership as a long-term investment and status symbol. It might be a private equity firm operating out of a sleek office in London or New York. It might be a cryptocurrency fund that owns ATM networks purely as diversification assets on their balance sheets. These owners don't care about customer experience. They don't care about transaction speed or machine reliability. They care about one thing: profit extraction. Owning a private ATM network is basically a massive high-stakes financial extraction business. To make your money back, you have to extract value from transactions at rates that justify the staggering capital investment. There are three main revenue models, each with a vastly different risk profile and income structure. Number one is the surcharge model, a safety bet for owners. The ATM charges customers a fee for withdrawals, typically $2 to $3 per transaction. The owner keeps a percentage of that fee, usually 50 to 70%, with the rest going to the operator and the bank. If transaction volumes are high when you launch, you lock in strong guaranteed returns. But if regulations force you to reduce surcharges, your revenue shrinks and profitability collapses. Number two is the operator acquisition model. The ATM owner acquires operators through placement agreements, bonuses, and revenue sharing. A single operator placement might cost $500 to $2,000 in incentives, but the lifetime value of an operator is calculated ruthlessly. If an operator places a machine that generates 500 transactions per month at $3 per transaction, the owner expects to profit $750 per month from that machine, but most operators churn within 2 to 3 years because they relocate or go out of business. The average operator lifetime value is $5,000 to $15,000 in profit for the owner. The economics are so predictable that ATM owners can model operator cohorts with precision. Number 3 is the data monetization model. The ATM network collects massive amounts of data on every transaction, withdrawal amounts, times, locations, frequency patterns, and behavioral trends. This data is worth millions. ATM owners sell it to financial institutions, marketing firms, and other financial service companies. They use it to build profiles of cash usage patterns and target operators with personalized offers designed to maximize lifetime value. The data harvesting is so sophisticated that ATM owners can predict transaction patterns with stunning accuracy. This is where the system reveals its true nature with brutal clarity. When regulations tighten in major markets, ATM owners face an existential crisis. Demand for cash doesn't disappear, but profitability collapses as compliance costs surge and operator acquisition becomes more expensive. ATM networks that were generating $5 million per year in profit suddenly face $1 million in annual compliance costs. They desperately cut costs, reduce machine maintenance, or relocate to less regulated jurisdictions. Suddenly, ATM owners found themselves holding networks with no one to operate them profitably. Networks that were generating $5 million per year in profit were now generating $1 million. Owners faced a difficult choice: accept pennies on the dollar to sell the network, or hold out and hope regulations relaxed. Many chose wrong and went bankrupt themselves. The separation of ownership and operations spreads risk, but it also creates contagion across the entire financial system. When operators fail, owners suffer catastrophic losses that cascade through their portfolios. How do these owners afford the ATM networks in the first place? Because almost no one pays cash. The typical financial structure is 20 to 30% equity and 70 to 80% debt. Specialized ATM finance companies provide colossal loans secured by the network's future revenue as collateral. To protect themselves from catastrophic losses, owners use a legal shield called a special purpose vehicle. If a wealthy investor owns 50 ATM networks, they do not own them under one massive corporate umbrella. Instead, they create 50 separate shell companies, often registered in tax havens like the Cayman Islands, Luxembourg, or Ireland. One company, one network. Why? Because if a network faces regulatory collapse or becomes worthless, the rest of the portfolio is protected from creditors. But there's a massive problem lurking here. Let's say you borrow $35 million to buy a $50 million ATM network. A year later, regulations tighten, and the network's valuation drops to $20 million. You're now underwater on your loan. Collateral is worth less than the debt. The bank panics and demands cash immediately. If you can't pay, they seize the network. ATM industry history is littered with the corpses of over-leveraged companies that made exactly this mistake. Let's assume you managed the debt perfectly and never faced a margin call. You still face another enemy that's far more insidious: regulations. An ATM network lasts 7 to 12 years before becoming obsolete, but regulatory rules are currently turning the industry upside down with alarming speed. The push to reduce cash usage and implement stricter surcharge caps means sudden mandates for new compliance features, enhanced security systems, and reduced fee structures, costing millions per network. Furthermore, what happens if you build an ATM network today that operates in 30 states to find out in 5 years that the global standard is stricter surcharge regulations? Your network becomes a stranded asset overnight. It's too expensive to operate, illegal in certain jurisdictions, and impossible to sell. Is $50 million drops to near zero. Owners are constantly gambling on regulatory trends, cash usage patterns, and geopolitical shifts. ATM ownership rewards patience and heavily punishes overconfidence. Because of this volatility, ATM networks are traded just like volatile commodities on global markets. A network generating $5 million per year in profit might be worth $100 million in a boom because investors want ATM networks today, or drop to $30 million in a crash. Some owners don't even intend to operate the network for its full lifespan. They speculate relentlessly. Buy low, acquire operators aggressively, sell high, and when a network finally reaches the end of its profitable life, it still holds some value. It might be sold to a competitor who consolidates it into a larger network. The owner receives payment based on the remaining operator base and brand value, typically 10 to 20% of the original purchase price. It's a pittance compared to the original $50 million purchase price, but it's better than nothing. The network that once generated millions in annual profit is reduced to a brand name and an operator list. So why does this chaotic system work at all? For an operator like Cardtronics, owning every ATM network they operate is incredibly capital-intensive and debt-loaded. If global cash demand slows down, an operator with 50 owned networks still has to pay 50 mortgages, even if they're generating minimal profit. Licensing provides maximum flexibility. If demand drops, the operator simply lets their licenses expire and hands the networks back to the owners. The operator stays lean. The owner takes the financial hit. This separation of ownership and operations spreads risk across the global financial system. When an operator goes bankrupt, the networks don't disappear. The owners simply license them to a competitor. Companies may die, but the networks keep operating. The ecosystem adapts because ATM networks are valuable regardless of who operates them. But here's where it gets truly rigged and unfair to ATM owners. Operators operate on razor-thin margins, typically 5 to 15% profit on revenues. Operator acquisition costs represent 20 to 40% of operating expenses. When competition intensifies, operators hemorrhage money and cut routes. When competition eases, they profit and expand aggressively. But ATM owners face a completely different problem. If competition intensifies, operators reduce licensing fees and return networks. If competition eases, operators demand more networks, driving up licensing rates. Owners are constantly hedging against competitive volatility, a variable completely outside their control. A sudden regulatory change that increases compliance costs can bankrupt both operators and ATM owners simultaneously. The machine manufacturer industry itself is rigged by design. Only a handful of companies build ATM machines, NCR, Diebold, and a few others. They control the entire supply chain completely. When you order an ATM network, you're not just buying machines. You're entering a multi-year contract with deployment timelines that stretch years into the future. Prices fluctuate based on manufacturing costs, geopolitical tensions, and demand cycles. You have no alternatives, no negotiating power, and you're locked into whatever terms the manufacturers dictate. During regulatory crackdowns, networks that had ordered machines for $50 million suddenly found them worth $10 million before deployment. They were forced to either accept massive losses or cancel orders and face severe penalties. The manufacturer oligopoly means you have no escape. Behind every private ATM you use is a complex web of financial players you'll never see or know about. There are ATM holding companies that own hundreds of networks. There are investment funds that buy networks as diversification. There are private equity firms that own networks as long-term assets. There are wealthy individuals from Eastern Europe and Asia who view ATM ownership as a status symbol and investment vehicle. There are even ATM brokers who buy and sell networks like commodities, taking a cut on every transaction. This hidden financial ecosystem is worth hundreds of billions of dollars, yet it operates almost entirely outside public awareness and scrutiny. ATM ownership is increasingly entangled with geopolitics in dangerous ways. When countries push toward cashless society, Western ATM networks lose access to entire markets. When the European Union implemented stricter cash transaction regulations, ATM networks lost billions in potential revenue. When China restricted cash withdrawals, ATM networks lost their primary market. When the UK implemented stricter surcharge regulations, networks had to implement expensive new compliance systems. ATM networks became weapons in geopolitical conflicts, and owners found their assets devalued or worthless. Geopolitical tensions can instantly destroy the value of ATM portfolios, a risk that's impossible to fully hedge against. Owners are at the mercy of government decisions they can't control. The licensing agreements themselves are masterpieces of financial engineering designed to protect operators at the expense of ATM owners. Operators negotiate clauses that allow them to terminate licenses if they become uneconomical. They negotiate revenue sharing that shifts the burden of operator acquisition costs onto owners. They negotiate residual value guarantees that protect them if network values collapse unexpectedly. Owners accept these terms because they're betting on long-term appreciation and licensing income, but they're essentially betting against themselves. They're accepting downside risk in exchange for modest upside returns. Consider the economics of a typical ATM network license carefully. An owner buys an ATM network for $50 million with $15 million of equity and $35 million of bank financing. They license it to an operator for $1 million per year. After 10 years, they've collected $10 million in licensing fees. They've paid off the $35 million loan plus interest, roughly $50 million total. They've paid compliance costs, machine maintenance, and other expenses, roughly $15 million total. They've collected $10 million in licensing fees. Their net return is 10 minus 50 minus 15 equals negative $55 million. They've lost money. But wait, they still own the network. If it's worth $20 million at the end of the license, they profit negative $35 million. If it's worth $5 million, they lose $50 million. If it's worth zero, they lose $65 million. The entire return depends on the residual value of the network at the end of the license, a variable that depends on regulations, technology, and geopolitics. It's a bet, not a sound investment. This is why ATM owners are constantly monitoring regulatory changes, operator acquisition trends, and competitive dynamics like hawks. They're not passive investors, they're active traders trying to time the market perfectly. Some owners buy networks during a regulatory crackdown for $15 million, license them out, and sell them during a boom for $50 million. The difference, minus financing costs, is profit. Others buy at the peak, license them out, and watch regulations tighten, losing everything. The difference between success and bankruptcy is often just timing and luck. It's a casino for sophisticated players with billions at stake. The secondary market for struggling networks is where the true desperation shows clearly. When a network reaches 5 to 7 years old, it becomes harder to license to major operators because they prefer newer machines with better technology. Older networks are sold to smaller operators, cryptocurrency platforms, or companies in less regulated jurisdictions at steep discounts. A network that once licensed for $1 million per year might be sold for $5 million to a smaller operator. The owner takes a massive loss, but at least they get cash and eliminate the risk of the network becoming completely worthless. The secondary market is a dumping ground for networks that owners can no longer profitably operate. And then there's the ultimate endgame, network shutdown and asset liquidation. When a network reaches the end of its profitable life, it's shut down, the technology becomes obsolete, the operator base becomes worthless, the brand becomes toxic. The owner receives payment based on the remaining value of the network, typically 5 to 10% of the original purchase price. It's a pittance compared to the original $50 million purchase price, but it's better than nothing. The network that once generated millions in annual profit is reduced to nothing. The ATM industry faces an existential transition that threatens network values everywhere. Stricter regulations, cashless society mandates, and surcharge restrictions are coming. But the timeline is profoundly uncertain. Network owners are gambling on which regulations will stick and which will be delayed. An owner who invests in a network designed for strict regulations might find the regulations delayed by a decade, leaving them with overcompliant assets. An owner who bets on loose regulations might find their network banned from major markets within 5 years. This regulatory uncertainty adds another layer of risk to an already precarious business. Owning a $50 million ATM network isn't just about managing debt and predicting demand cycles. It means betting on the future of cash usage itself. Not all networks make it to their 10-year lifespan in active operation. Some are retired early due to regulatory pressure, technological obsolescence, or simply becoming unprofitable. These networks enter the secondary market, where they're sold at steep discounts to smaller operators or cryptocurrency platforms. A network that once served millions of transactions might be converted to a niche platform and operated until it's literally generating no profit. The secondary market is where networks go to die slowly, generating minimal returns for owners but keeping the asset from total loss. Eventually, even these networks reach the end of their lives and are shut down completely. Regulatory changes are reshaping the entire industry with unprecedented speed and severity. New mandates for surcharge caps, cash tracking, and compliance standards force expensive retrofits on networks. A network designed for loose regulations might become illegal to operate if the industry shifts to stricter standards. A platform certified for one region's market might be banned in another due to surcharge regulations. Owners are constantly gambling on which regulations will stick, which will be delayed, and which will render their assets worthless. A $50 million network can become a stranded asset overnight if regulations shift unexpectedly. The entire system is designed to extract value from ATM owners and transfer it to operators and manufacturers efficiently. Operators get to use expensive networks without owning them, maintaining flexibility and minimizing capital requirements. Manufacturers get guaranteed demand and long-term contracts. Banks get interest payments and collateral. Brokers get transaction fees on every deal. ATM owners get the residual risk and the hope that they time the market correctly. It's a rigged game where the odds are stacked against ownership. Yet the system persists because it works for everyone except owners. When an operator goes bankrupt, it returns its licensed networks to owners without hesitation. During economic crises, some operators faced existential crises as operator acquisition costs surged and compliance requirements increased. Suddenly, hundreds of licensed networks flooded back to owners who had no way to redeploy them. Networks sat idle, burning money through maintenance costs while generating zero revenue. Owners faced a choice: accept pennies on the dollar to get the networks off their books, or hold out and hope demand returned. Many chose wrong and went bankrupt themselves. The separation of ownership and operation spreads risk, but it also creates contagion. When operators fail, owners suffer catastrophic losses that ripple through their entire portfolios. Operator acquisition cost volatility is the invisible killer of ATM owner profitability. Operators operate on razor-thin margins, typically 5 to 15% profit. Operator acquisition costs represent 20 to 40% of operating expenses. When competition intensifies, operators hemorrhage money and cut licensing fees. When competition eases, they profit and expand, but ATM owners face the inverse problem. If competition intensifies, operators reduce licensing fees and return network. If competition eases, operators demand more networks, driving up licensing rates. Owners are constantly hedging against competitive volatility, a variable completely outside their control. A sudden regulatory change that increases compliance costs can bankrupt both operators and ATM owners simultaneously. Consider the impact of a single regulatory event. When several states implemented strict surcharge caps, compliance costs surged, operators faced losses, ATM owners faced reduced licensing income. When the European Union tightened cash transaction regulations, entire markets closed. Networks lost access to millions of transactions. ATM owners faced reduced capacity utilization. Every regulatory change sends shockwaves through the entire ATM industry, hitting owners hardest because they have no control over operation. They just collect licensing fees and hope the market stays stable. ATM holding companies themselves are complex financial structures with their own risks. They manage thousands of networks worth hundreds of billions of dollars. They finance this with debt markets. If debt becomes expensive, their returns shrink. If credit dries up during a financial crisis, they can't finance new network purchases. If their own credit rating drops, their cost of capital increases. ATM holding companies are exposed to financial market risks that have nothing to do with cash itself. Credit crisis in London or New York can bankrupt ATM owners in Singapore. Concept of stranded assets haunts every ATM owner. Technology changes, regulations shift, and suddenly an asset that was worth hundreds of millions becomes worthless. A network optimized for loose regulations becomes obsolete as the industry shifts to stricter standards. Platform designed for traditional cash handling becomes a liability if cryptocurrency becomes mandatory. Owners are constantly making bets on regulatory adoption, technology standards, and competitive directions. Wrong bets destroy wealth. Right bets create it. Some ATM owners don't even intend to hold networks for their full lifespan. They speculate ruthlessly. Buy a struggling network during a regulatory crackdown for $10 million, license it out aggressively, and sell it during a boom for $40 million. The difference, minus financing costs, is profit. But timing is everything. Buy at the peak and you're underwater immediately. Sell at the bottom and you lock in losses. It's a high-stakes game where milliseconds of timing can determine success or bankruptcy. Most speculative owners lose. A few win generational wealth. The secondary market for niche networks is particularly volatile. As the industry consolidates, smaller networks flood the secondary market. They're sold to cryptocurrency platforms, smaller operators, or companies in less regulated jurisdictions at steep discount. A network that once served millions of transactions might be sold for $3 million to a niche operator. The original owner takes a massive loss. But that network still generates some returns before being shut down completely. The secondary market extends the economic life of networks, but at deeply discounted rate. ATM financing is the lifeblood of network ownership, and it's incredibly complex. Gaming finance companies provide loans with complex covenants and restrictions. The loan amount depends on the network's age, technology, and earning potential. Interest rates depend on creditworthiness, market conditions, and regulatory forecasts. If the bank believes cash demand will decline, they demand higher interest rates. If they believe it will surge, they offer lower rates. Owners are gambling against banks on the direction of cash demand. Most owners guess wrong and overpay for financing. The insurance markets for ATM networks are equally complex. A network worth $50 million needs insurance against cyber attacks, fraud, regulatory penalties, and liability claims. Insurance premiums are based on the network's security infrastructure, compliance history, and regulatory exposure. Operating in jurisdictions with strict regulations costs more to insure. Operating in jurisdictions with loose regulations costs less to insure but carries higher regulatory risk. Insurance is another cost that directly impacts returns. Higher insurance costs mean lower profitability. Network utilization rates directly determine profitability. If a network attracts 1 million transactions per month, it generates more licensing income than if it attracts 500,000 transactions. Operators optimize marketing to maximize utilization. But global cash demand fluctuates seasonally and cyclically. Summer cash usage booms. Winter cash usage shrinks. Economic crises reduce cash demand. Regulatory changes reduce cash demand. Technological disruptions reduce cash demand. Utilization rates swing wildly, and ATM owners suffer from low utilization. A network that should generate $1 million per month but only attracts half the transactions generates just $500,000. The mortgage doesn't change. The entire system rewards operators and manufacturers while punishing owners. It's designed this way intentionally. Manufacturers want predictable demand and long contract terms. Operators want flexibility and minimal capital requirements. Banks want collateral and interest payments. Everyone else absorbs the risk. ATM owners are the margin providers who enable the system to function. Without owners willing to hold networks and accept the risk, operators would have to own everything, and capital requirements would skyrocket. The system distributes risk in a way that incentivizes ATM ownership despite its precarious nature. If you want to understand modern ATM empires, you have to understand network ownership. You have to understand how Eastern European oligarchs control 20% of the world's ATM networks. You have to understand how private equity firms pool money from ordinary investors to buy networks for financial returns. You have to understand how cryptocurrency funds use ATM networks as diversification assets. You have to understand that the ATM you're using is ultimately owned by someone trying to generate returns by betting on regulations, technology, and cash behavior. The system is rigged, but it's also efficient. It allows capital to flow to where it's most productive. The truth about ATM network economics is far stranger than fiction. Behind every machine you use is a complex web of financial engineering, regulatory gambling, and capital allocation that would make most investors' heads spin. The owners of these networks are betting billions on the future of cash, the direction of regulations, and the behavior of millions of operators and users. Most of them lose. A few win generational wealth. The system persists because it works for everyone except the owners, and that's precisely why it will continue to exist. If you found this deep dive valuable, please subscribe to the channel and hit the notification bell so you never miss another investigation into how global financial systems actually work. Share your thoughts about ATM ownership in the comments below, and thanks for watching.